So friends, now we will talk about the activity ratios. Activity ratios are basically ratios which indicate the operating efficiency of a company or how well the assets are being utilized of a company. Therefore, the other names for activity ratios are basically asset utilization ratio and operating efficiency ratio. Now, there are a series of activity ratios that we are going to discuss. Among them, the first one is the inventory turnover ratio. This is defined as the cost of sales or cost of goods sold, cost of sales or cost of goods sold divided by average inventory. Right. So let's say the cost of goods sold divided by the average inventory comes to a value of 4. This means that within a certain period, the inventory is liquidated 4 times. So let's say the period is a year and we have a cost of goods sold by average inventory giving a ratio of 4. That means the inventory was liquidated 4 times during this period. What is the definition of average inventory? It is basically the inventory at the beginning of the period plus the inventory at the end of period divided by 2. This is the definition of average inventory. Okay. Now the second ratio that we come across is days of inventory on hand. Days of inventory on hand. This is defined as the number of days in the period divided by the inventory turnover. Number of days in the period divided by inventory turnover. So let's say we are talking about 1 year period and the inventory turnover was 4. Therefore, days of inventory on hand will be calculated as 365. That is the number of days in the period. If it is 1 year, the number of days is 365 divided by 4. This comes to 91.25. What does this number signify, friends? Basically, this signifies that the inventory to get liquidated once completely takes 91.25 days on an average. This is what it signifies. Typically, the lower this number is, the better it is. And for inventory turnover, the higher the number is, the better it is. Now we come to receivables turnover. Receivables turnover is defined as sales divided by average receivables. Average receivables again is basically receivables at the beginning of the period plus receivables at the end of the period divided by 2. Now let's say this number is 3. Sales by average receivables, the number is 3. This means at any time 1/3 of the sales is outstanding in terms of receivables. So the money has not yet come to the account. 1/3 of the sales has not been accounted for, or the money for that has not been received yet. Days of sales outstanding. Days of sales outstanding is basically the number of days in the period divided by receivables turnover. Divided by the receivables turnover. Now let's say the receivables turnover is 3 and the period is 1 year or 365 days. Therefore, the DOS or day sales DSO, this will be DSO. So let's say the period is 1 year, which means 365 days, and the inventory turnover is 3, as we mentioned earlier. Therefore, the day sales outstanding will come to 121.67. This means that over the period, whatever sales are made, out of that 121.67 days of sales are outstanding in terms of payments. So generally, the lower this number is, the better it is. Inversely, the higher this number is, the better it is. That is, the receivables is much lesser in proportion in terms of sales. This signifies payables turnover. This is defined as the amount of purchases in the period, divided by the average trade payables. Average trade payables. What is the definition of average trade payables? It is basically the payables at the beginning of the period and payables at the end of period divided by 2. Right? So let's say this number is 5. That means 1/5 of whatever purchases are made, the payment for that is outstanding for that period. Right? So generally, having a comfortable number here is good. A low number can be good for this, but too low may mean there is cash crunch and the suppliers are not being paid properly. That can also be the case, right? Number of days payables. This is basically number of days in the period divided by payables turnover. Number of days in the period divided by payables turnover. If the payables turnover is 5 and the period is 1 year or 365 days, this comes to be 365 by 5. This is equal to 73. So basically, in a single period, 73 days of purchases are not paid for in that same period. They are outstanding. So this number should be healthy, should not be too low, but should not be too high also. That can also be an indicator of liquidity crunch. Now we come to working capital turnover. This is basically the sales or revenue for a single period divided by the average working capital. Working capital. The definition of average working capital, again guys, is basically working capital at the beginning of the period plus working capital at the end of the period divided by 2. Average of it, right? So let's say this number is 3. This means say the currency is in dollars, so $1 of working capital produces $3 in revenue or sales. Generally, the higher this number is, the more efficient the usage of working capital is considered to be. Fixed asset turnover. This is basically signifying how efficiently fixed assets are being used to generate revenues. So this is again sales or revenue divided by average net fixed assets. Again, the definition of average net fixed assets is basically net fixed assets at the beginning of the period plus net fixed assets at the end of the period divided by 2. Now let's say this number is 2.5. This means $1 of net fixed assets or average net fixed assets is producing $2.5 of revenues or sales. So generally, the higher the number is, the better it is. Same goes for total assets turnover. This is sales or revenue divided by total average total assets. Average total assets is basically total assets at the beginning of the period plus total assets at the end of the period divided by 2. Here, let's say the number is 1.5. This means that $1 of assets is producing $1.5 of revenue. Generally, in this simple manner, we can understand that the higher this number is, the better it is.